In our last market update, we said that we did not want to see the interest rates on a 10-year Treasury bond break above 4.5%. Well, since then, it has cracked above that level and raced higher. We're going to tell you what it means for your money. Also, oil continues to stay above $100 a barrel. That is driving inflation higher. We're going to discuss it. And lastly, Kevin Warsh is the new Fed chair, but his playbook that we expected just 3 months ago of rate cuts, the market is now pricing in rate hikes by the end of the year. We got you covered and a lot more. Let's get into it. So over the last few months, we have talked a lot about the 10-year Treasury bond and what the rate on that has been doing. This is a key rate that determines mortgage rates and the rates that businesses, when they go to borrow, what they're going to pay. And it's very important for the stock market. You can see over the last year, this is the range this has been in. And we had been remarking that every time this got up around 4.5%, it would go lower. This is something that President Trump back in April of 2025, this rate went from 4 to 4.5% in 2 days. And that caused him to do a 90-day pause on the tariffs, which caused the markets to go up 3,000 points in 10 minutes and started off a 7-month rally. But since then, we have again had 3 or 4 times this has reached 4.44 to 4.5%. We did not want to see this getting above 4.5. You can see on the far right, though, it has broken through and broken out all the way up to 4.68% as we film this in late May. And part of the reason for this breakout is that commodity prices keep going up. Oil prices keep going up with the conflict in the Middle East, and that has caused inflation to go higher. So we wanted to highlight this. This is going to be worth watching closely in the days to come because, for example, a 30-year mortgage is now at 6.7%. We have seen in the past that when that rate gets at 6.5 or higher, it really puts a freeze over housing, which is a key sector for the overall economy. So we want to see this come back down, get below 4.5%. So oil continues to be above $100 a barrel. Gas is above $4.50 a gallon nationally. That is killing the wallet for a lot of people across the country. And you can see that in just a few months, oil has gone from $56 a barrel pre-conflict to $107 now. It was at $114 late in March. That was its peak. That's when Trump did his first pivot on the Iran deal, and that was the low in the stock market. Stocks have been performing a lot better recently, even with oil prices this high, but that may not last for that long. Now, the other impact that higher commodity prices are having is on inflation. And we talked about the fact over the last couple months, inflation we wanted to see remain in the 2 to 2.5% range. The Fed wants inflation at 2%. To see rate cuts, you really need to see it there. That is not happening. And in fact, the most recent numbers here, we got 3.8% for the CPI, the Consumer Price Index. Many of you have heard of that. That is year over year, saying prices are up 3.8%. The PCE, which is the Fed's favorite measure of inflation, at 3.5%. Lastly, the Producer Price Index, 6% year over year. This was a stunner. This is wholesale inflation, business inflation. We hope this wasn't a 1-month aberration. This thing can bounce around a lot. We want to see it in the months to come back down to that 3 to 4% range. Now, the next chart we want to cover is very interesting. There's a lot of people saying, hey, why is the economy not hurting more than it is with oil above $100 a barrel? And it is a great question. The answer is in the next chart. This measures the U.S. oil intensity, as you can see there. In other words, How many barrels of an oil does it take for $1 million of US GDP to be produced? Now, we know that back in the 1970s, that we were a goods economy, and we have a transition to a services economy over the last 10, 20, 30 years. We'll take a look at the drop off there from almost 3 barrels of an oil needed to 1/2 of 1 barrel. Here's what this means. If this was the 1970s and oil was at $100 a barrel, we would be in a recession now, no doubt about it. But because our economy takes a lot less oil now to produce it than it did then, the economy is continuing to chug along. Now, to further that point, we like to look at the Atlanta Fed. They have a tracker for the US economy. What rate of growth are we expecting the economy to see in that particular quarter? And right now we're talking about the second quarter, and this shows that over the last month, estimates have been rising and just hit 4% for the economy. That is an incredible growth rate, especially considering, like we talked about just a minute ago, that oil is over $100 a barrel. In normal times, 2% is kind of what you would expect as a pretty good growth rate. This is 2 times that. Definitely a surprise to a lot of economists who thought we would be hurting a lot more than we are right now. Now, the next thing I want to talk about is we have a new Fed Chair, Kevin Warsh. We talked about him and some of his background in our last video, but why I want to revisit this is just 3-4 months ago, expectations were that Trump was going to appoint someone who was going to cut interest rates, and it was expected Warsh would do that. But because inflation has gone up and commodity prices have gone up, the market's belief there has flipped completely. In fact, this is taking a look at what the market thinks interest rates are going to be by the end of this year, 2026, in December. This is talking about overnight interest rates, by the way, that the Fed sets. They don't set the 10-year Treasury that we talked about earlier. Right now, interest rates are at a range of 3.5% to 3.75%, and the market is saying there's a 39% chance rates will still be there by the end of the year. But to the right, 42% chance that the Fed will have hiked rates once by the end of the year. And if you go out, there's an almost 18% chance that they will hike rates 2 or 3 times. Now, I don't think we're going to see 2 or 3 rate hikes, and we may not see any, but this is a real change from just a few months ago when a lot of people expected there were going to be rate cuts. It will bear close watching, and a lot of this will also depend on how quickly does the conflict in the Middle East end. The longer it goes on, the more likely the Fed will actually have to hike rates. There is a saying that the market likes to test a new Fed chair, and what we're talking about is if you look at the last 5 or 6 Fed chairs, there tended to be a little bit of drama or volatility in the markets in the months to come. So we wanted to put up a chart taking a look at the last 5 Fed chairs, and you can see this goes back to 1979, Paul Volcker, who took over with inflation sky high. Anyone who was alive in the late 70s, early 80s, when mortgage rates were 18%, understands what we were talking about there. But what you'll notice with each of these, over the first 6 months, on average, there was a sell-off here, 10% for Paul Volcker, 33% for Alan Greenspan, which 21% happened in one day, Black Monday, very vicious. Thankfully, I was only 9 at the time, so I don't remember that very well, but that was very ugly for him. Ben Bernanke down 7.7%. Janet Yellen just down 4%. So that was, I think you'd take that. Kevin Warsh would if you could tell him. And then Jerome Powell down 7.3%. Now, the question is, okay, if there's a big sell-off somewhere in the first 6 months, Was it not a good time to invest? Well, looking out 1 year later, so this would include that sell-off, take a look, you will see that 4 of the 5, the markets were higher, in some of these cases a good bit higher 1 year later. And if you go to the far right, by the end of their term, you can see huge returns for all of these Fed chairs. So it's something to just keep an eye on. It wouldn't be a surprise if we had extra volatility in the next few months. Now, speaking of investing at the top of a mania, we put together a guide of portfolio red flags, mistakes that we often see when we're looking at portfolio statements from prospects, and that's one of the big ones on there. If you want a copy of that, you can click the link in the description and we'll send it to you. All right, the next chart that I want to cover is looking back at late March, early April. We talked a lot about technology because there were a lot of people on CNBC and Fox Business saying, look, tech stocks have underperformed this year. This could be a 2, 3, 4-year pattern. We, on the other hand, said tech was trading at some of the lowest valuations in the last 10 years. We liked tech. It's a key part of our client portfolios. Well, from March 30th till today, May 21st, lo and behold, tech, the QQQ Trust, you can see there, which is the NASDAQ, up almost 25%. Right under that, the S&P 500 up 16%. So you're talking about an over 50% better return there. The Dow Jones Industrial Average up 9.6. The equal weighted S&P 500, that means the average stock in the S&P, up only 7.39%. Emerging markets up 16, international stocks 11, and gold, something that a lot of people in late March said you had to put a lot of money in, down 0.5%. So again, we go over these things because a lot of time the narrative and all public opinion is on one side of an issue and often gets it wrong. Now it's time for rapid fire. And this is where I go over some key charts I think you need to know about. We're going to start off taking a look at foreign holdings of U.S. Treasury bonds. Now, it takes a nerd probably to get excited about this topic, but basically throughout 25 and a lot of 26, a narrative has been that foreigners are selling U.S. Treasuries and taking their money home. That is not the case. In fact, this takes a look going back to the 1970s, taking a look at international investors, foreigners, how much U.S. Treasury bonds do they hold, and you can see this has pretty much consistently been going up over the last 40, 50 years and is at a new all-time high as of late March of 2026, $9.24 trillion. That is a huge number. And it says there still is a lot of demand for U.S. Treasuries from international investors. That is good to see, and it's much different than what the headlines have said for a lot of the last year, year and a half. All right, the next chart we're taking a look at, looking at the presidential calendar and what the biggest sell-off during the first year, midterm year, and then there's the pre-election and election year. We're not going to focus on that. We're looking at the midterm year. On average, has seen a decline of 17.5%, and you can see that is much lower than any of the other years. What's interesting, though, is 1 year from that low, you can see the gains have been almost 32%, much, much higher than any of the 3 years. So what this is saying is we could get volatility. There could be a bigger sell-off later in the year. But if that does happen, oftentimes the stock market bounces back in a very big way. All right, last chart. We are looking at the current valuation of OpenAI, which is ChatGPT's parent, and Anthropic, which is Claude's parent. These two, there has been so much excitement around these companies. Both of them are expected to IPO, go public this summer, along with SpaceX. So a lot of excitement for those three companies. In the private markets, the valuation of OpenAI and Anthropic has been going straight up. And you can see over the last 12 months or so, OpenAI has been going up. Anthropic is now valued at even greater than OpenAI is, up near $1 trillion. That is a huge valuation. There's a lot of excitement because they are growing so fast. It will be very interesting when these come public to see. We don't want a bubble to form. You don't want to see these valuations get much higher. So the key takeaway is that interest rates are up, oil is up, and inflation's up. But thankfully, so is the economic growth rate, and so are company earnings. So we think the markets can still power higher late in the year. Listen, if you are new to Centera Capital and you are not getting these kind of market updates from your advisor, we are here to help guide our clients through the volatility and chaos that we talked about today around the world. And if you're not getting that from your advisor, please reach out, CenteraCapital.com. Thanks for watching. Take care.